Welcome to today's Fireside Chat with CEO Andrew Luong and VP of Revenue, Mike Jue. My name is Kris, and I will be moderating the questions section. So if you guys have questions, please feel free to drop it in and we'll facilitate them throughout our conversations. So today we wanted to do a quick introduction. Most of you probably already know who Andrew is, but Andrew, can you tell a little bit about yourself?
Yeah, I mean, high level, I'm Andrew, one of the founders and CEO of Doorvest. I think aside from my day job and whatnot, just wanted to share a little bit of a background, as I think it might resonate with some folks. But the background to Doorvest and myself is was a busy working person, call it 2014, before that, etc. Always craved some long-term wealth building. And so when you kind of Google long-term wealth building, income, etc., like real estate, investment, home ownership, that sort of thing starts popping up. And so probably similar to a lot of our customers in the audience, stumbled into my first investment home in 2014 in Sacramento. Learned so many lessons along the way, made a million mistakes. But anyways, that first home led to the second one, which led to the fifth one, and then lo and behold, in a couple of years, as sort of a nights and weekends thing, built up a little bit over 10 home portfolio. And friends along the way, friends and coworkers and those within the network would start looking for advice and a way to get started. And so that kind of became the genesis of Doorvest. Anyways, long ramble. I'm Andrew from Doorvest.
Thanks, Andrew. Mike, you want to go next?
Great. How's everyone doing? I'm Mike, VP of Rev here at Doorvest. Interestingly, I'm kind of the opposite to Andrew. I've always been interested in real estate investment, but I've also always been a very busy working professional. And the feeling I've always had is I've been too busy to feel like I could do a good job being an old school real estate investor in my nights and weekends. I'm trying to do this on my own. I found, as I did my review, hundreds of times I kind of got started, hundreds of times where I'd abandoned it partway through and couldn't really finish pulling it through because it was too challenging or too risky. So I wish that earlier in my career, perhaps Doorvest had been around, but it's okay. I'm going to make up for some lost time now by working alongside you all here. Kris, if you are amenable, I'd love to just give a quick overview, a bit about what Doorvest does before we jump into it, just set the context and lay the table out. Just very high level, what does Doorvest do? We make it really easy for busy professionals to invest in real estate, often in geographies where they don't necessarily live, without having to invest a ton of time or become expert across all the things that you need to do to become an excellent real estate investor. So for those of you out there who are full-time or very serious real estate investors, this, but normally the process is very long, it's very capital intensive, and it can be quite risky depending on your skill level. I mean, just starting from the beginning, you have to look and underwrite hundreds of different properties, figure out which ones might be the best ones to invest in, figure out and scope how you might renovate, find all the vendors you might need to fix it up, to property manage, to maintain it over time, put a tenant in there. It takes a lot of time, takes a lot of your capital up front, but also to really build your skills up to a really expert level to feel good and to do it well. And that's where Doorvest comes in. Very simply, we do all the work. We use our experts to go out and do all those things. We look at thousands of properties, buy just the best ones to make available for you, have our tightly managed GC teams go in there and do the right amount of work, fix it up to a great standard, get a tenant in place, manage a property for you long term. So all you really need to do is to pick and purchase an investment home from our properties, stuff that's only on our platform, and poof, you're a real estate investor. A lot better than what I did back in the day. So thanks for that, Kris. I'll hand it back to you.
Cool. Thank you for that. All right. So to kick off today's fireside chat, we wanted it to be very conversational. So we did prepare a few topics. We're going to talk about investing in today's market, very top of mind for a lot of people. Some goals and strategies to consider. Why are clients still buying homes with us right now? We'll explore that a bit. Evaluating and analyzing properties, as well as other financing options that you can consider outside of conventional loans. And then again, we'll save some time at the end for Q&A. So definitely start asking any questions as the conversations are happening. I'll sprinkle them in, moderate it. If it otherwise, we'll save time towards the end to address. All right, so let's kick it off. The really big question: investing in real estate in this environment. What are your takes on it? And maybe let's kick it off with Andrew.
Thanks, Kris. What's going on in this environment? No, just kidding. Yeah, I mean, obviously we are in sort of an unprecedented macro environment. On one end, obviously everyone, I'm sure, has seen all the news headlines around rising interest rates as a sort of mechanism for the Fed to combat high inflation. And so I think even beyond the fact that interest rates today are higher than they were exactly a year ago, and certainly higher than they were a year and a half, 2 years ago, I'd say high interest rates are relative. And what that means is, like, yes, interest rates are higher today than they were a couple of years ago. But if you look at all-time averages, they're probably within range of all-time averages. If anything, they're still lower. But when we talk about the environment today, it's really the volatility, which means like low interest rates going to higher interest rates in a short period of time that led to this sort of broader market dislocation. Mike, did you have a comment? Feel free to jump in whenever too.
Yeah, I when I think about it as an investor, I agree with you, right? Best times for me to invest in as an investor is when the levers and variables I care about are sort of stable, so I can understand what I'm trying to do, what's going to happen. I can try to look into my very cloudy crystal ball and guess how things would go. When things are whipsawing, can be a little bit more challenging to kind of guess what the future holds. I might be a bit of a contrarian, and a precursor to this, I'm not an economist or a Fed expert. I just read a lot about people that think about the Fed. But we're in an interesting time when rates have ratcheted up really quickly over the last 6 months, a year. But with a lot of the recent events kind of coming into a place where the terminal rate's in sight, where the Fed is slowing down and bond markets are kind of pricing in a more stable mortgage rate environment coming through the balance of the year. Will it be as awesome as 2015? I wish. But is it different than 1996? We're kind of in a good spot. So once again, not a economist, but do read a lot about what economists think about the current environment. Andrew, I got a question for you, actually.
Yeah. Actually, let me jump in and comment on your piece a little bit, and then maybe we do the question after. Maybe we're heading in the same direction too. But yeah, I mean, I guess slightly different perspective from you in the sense that I tend to take a longer viewpoint, and I try not to time the market, etc. And so I think the fundamental question that I ask myself, and if a friends often come to me asking, like, should I buy now and things of that nature, the question is like, what are you looking to do with your investment? And so if the answer is, I want to make, I don't know, I'm going to make up a number, 100% return within a year because I need this capital, I would say, I don't know, maybe it does, but it's probably not a worthy calculus for you to, I mean, I want my real estate to appreciate 100% in a year too, but there's certainly not a guarantee that that's going to happen. However, if your objective is to continue your day job for X amount of time, say you have $50,000, $100,000 saved up sitting in cash, or maybe you have more than that, and your time horizon is like 20 or so years where you could buy this home, it'll build in value over time. You generate a little bit of income along the way. That little bit of income turns into more income because your rents appreciate. And then at some point you pay off your mortgage, you're sitting on a good chunk of assets. And because you paid off your mortgage, your cash, your income streams are higher as you head into retirement. Then I'm like, then my personal perspective is like, take your 100K, buy one home today, buy your next one in 6 to 12 months, save up for more, and continue to dollar cost average over time. So anyways, that's kind of my broad view. Mike, back to your question, if you still remember.
You're good. You pre-answered the question. One thing I had to ask when I think about entering an environment, right, is of course easy to make the case for who should invest. So you answered there. But I think it's also nice to think about who shouldn't invest in an environment. So if I'm summing up what you put together there, just to spare you having to repeat yourself, right? If you're looking to get rich quick on real estate, like I want to in 6 months have doubled my money, or perhaps you don't have the long-term view of reserves, maybe not the right time in this exact environment. And who should be, and correct me if I'm wrong, I think you say if it's a longer horizon, if you generally believe the direction of the US economy, US housing market, and you're sort of planning for longer goals, absolutely the right time to come in. So throwing the ball back to you if I summed up correctly, or if you have any more thoughts on that.
Yeah, I think that sounds about right to me. Like, what I would say is that real estate has historically gone up in value over time. If you look at any chart, it goes straight up and to the right. And when I say real estate, it's not only the value of the home itself, the home value appreciation, but also the rents. Like the rents grow almost as a straight line up and to the right. If you zoom in, you see the ripples, right? You see the ripples in the home values. You see sometimes the ripples in the rental amounts as well. But if you zoom out for 10 or so years, 5 to 10 years and onwards, the chart is sort of straight and up and to the right. So the question, I guess I would ask, I'd pose for you, Mike, is like, what's a world where you see that trend, this historical trend of home values going up and to the right and rental amounts going up and to the right, given a long enough time horizon? Like, what's a scenario where you see that no longer being the case?
That's an awesome question, actually, and it echoes back to questions that people ask me going back to the last, great financial collapse when everyone was scared of the stock market and thought maybe I'll wait. And the question they asked was, well, Mike, do you think that the US economy will exist in 10, 20, 30, 40, 50 years? Or do you think that the apocalypse is coming and that there'll be no more financial markets open? And if you believe the markets will be open in that long time period, this is just a blip. Maybe it's a buying opportunity you should get. And I think the same way around real estate, right? So I'd say, well, do we believe that the US housing market will exist in some kind of healthy fashion over the long run? We can get even crazier, right? I mean, is there some kind of weird shift, or perhaps people all move into floating containers in the sky that aren't homes to live in? Or is the way that we're living and the way we find shelter this roughly the same as today? And will the capital markets shift in some very dramatic, permanent fashion? If not, I think the long-term play is really good. And if you're not a super expert at timing out the stock market, bond markets, mortgage markets, housing markets, you are wiser to make the longer play. The same way you buy stocks, you don't kind of buy, you don't take your whole retirement account and buy more in the down months and then try to sell in the highs and time all these. You put it in over time. You go for the long play. Good financial advisors will tell you things like, put it there and just don't look at it for a long time. Sometimes not looking at it is the best investing feature you can have. Any alternatives? I might have stolen something you told me in the past in case I stole your thunder here.
No. I think the fundamental concept that I would anchor towards is, more or less what you said there, which is like housing is a fundamental utility. Housing as we know it today is a fundamental utility. And so the need for housing should continue to be there unless we live in containers or we all decide we somehow want to live on the streets or something. Like the need for housing itself will continue to be there. And so that's different from like a product or a service or a company, i.e. a stock, where that shifts. I guess the one point that I would point out is that, it's not 100% guaranteed. Maybe we all decide we don't want to live in the US and therefore US housing broadly might cease in its same capacity, maybe, but that's a very big bet, and I think that has many more implications than just talking about U.S. real estate as we talk about today. I don't know, maybe we all live in Mars in 10 years, and that becomes our permanent reality. Fine, I could see a world where if we all live in Mars, and Mars is somehow more attractive than living in the US, then maybe you shouldn't be making a long-term bet in US housing. But generally speaking, and this is my personal viewpoint, is by real estate, the goal is to hold on to it for the long run and not think about it and not think about sort of the day-to-day ripples. Actually, I'll add on that. Like my biggest real estate investing mistakes have always actually, for personally, have been where I couldn't hold on to home for long enough, and that's always been my sort of regrets.
I wanted to take it a little bit further here and ask this question. Who are the type of people who are investing right now? What are the trends that we're seeing here at Doorvest because we still have clients buying homes, identifying properties. So what are the common themes, the goals maybe that they're focused on to continue on building their portfolio, buying real estate at this time?
I can jump in on this. And I think we live in a weird era, right? We can read in the news, you can read Market Watch or the Wall Street Journal, any paper all day long, and you see a lot of just scary news about the market. But as we talk to our friends, family, our customers, people are identifying it. These ripples don't always make their way to Main Street. So we have a lot of customers who, perhaps like some of the people on this call, working professionals in a job. There's a lot of scary headlines, but we're continuing to work, save, live our lives, grow our families as normal. And they come to a stage where they realize perhaps they're very long in equities or they're long in cash, and they're just thinking a bit more about what inflation does to this cash that's in the bank account over time. And real estate exposure is the right thing for them. I think for many of these people, they're looking at it not as this is an opportunity to buy one single property and it's going to solve your diversification issues. They're more thinking about it, oh, it's time that I add this tranche of diversification to my portfolio, and that this is the beginning of their real estate journey. So we're seeing a lot of those folks engage. Interestingly, we're seeing a lot of folks who have accumulated quite a bit of stocks over time, looking to not just own a lot of stocks, single stock or index, or perhaps folks who've accumulated a lot in retirement accounts like IRAs, 401ks, or whatnot, where they're planning for the future a little bit more and want to not only have stock market exposure in their long-term savings.
Cool. Have a
Mike,
question from, oh, go ahead.
No, go ahead.
All right. A question from the audience because we're talking about diversification right now. Flipping it back to Doorvest though, in the name of diversification, would Doorvest consider other flavors of real estate, such as commercial real estate, examples being like small office spaces for doctor practices, etc. So expanding our product line from single family investment properties to other aspects.
I guess I'll take that question. Just a comment real quickly on kind of what Mike mentioned before too. And Mike, I think you and I are quite aligned on this too. I don't think the case that we generally make as a company, Doorvest, the company, does not make the case where if you have 300K in assets, all 300K goes to real estate. It's if you have 300K in assets, maybe 50K, maybe 100K should go towards real estate. And so to the point of like the counter example, if you have 50K in assets, probably like your only assets are 50K, maybe you shouldn't buy real estate. Maybe you should own some stocks, contribute to your 401k, pay off your credit card debt, whatever it is first. And then at some point you accumulate some asset, and then you should be thinking about real estate. And so part of it is similar to the scenario that you just outlined, which is like, if you have 600-700K in your 401k and nothing else, maybe you should consider moving a part of it or somehow getting some exposure to direct single family American real estate. And I think this actually speaks to the chat that I think you and I were having the other day too, which is like our personal journeys. Obviously, I'm personally a bit more indexed in real estate ownership, and maybe you're slightly less for a variety of reasons too. And so the reality is probably just a combination of the both. Anyways, to the question that I kind of talked in the circle before getting back to, I think 100%. Like our high level, we as a mission, our mission is to advance financial security for all. And so that starts with making investment home ownership accessible to anyone, anywhere. Vast majority of our customers are first-time homeowners, and vast majority of our customers have purchased a subsequent home too. And so, and the reason why we started there was because buying an investment home is really hard, and real estate oftentimes represents a major asset class that a lot of folks are unable to access. Beyond that, no immediate plans for some of these pieces specifically, but definitely in sort of the medium term is stuff that we think about. We think about short-term rentals, we think about midterm rentals, we think about other flavors of real estate, et cetera. Something that we have floated around recently was so for those that understand the Doorvest business model, we buy a home on customer behalf with our own money. We renovate a home on customer behalf with our own money too. And in order to do that, we raise a lot of real estate debt to fund that. And so a product that we've considered in the past is what if we gave our customers the chance to fund us the debt, i.e. lend to Doorvest, and then charge an interest rate, and then we use those funds to go buy the real estate versus borrowing from a bank, which is what we do now. But anyways, general answer is yes. The question is just like,
we have another question along the same lines of, what makes Doorvest unique compared to other similar companies?
With Doorvest homes, typically we manage that home. We manage a tenant in that home. We'd like to do it for a really, really, really long time. And the consequence of that is we put a lot of work in on the front end to make sure that that home, that tenant is easy to manage for a long period of time. So since we're standing alongside you for the entire real estate journey, sort of from purchase, reno, tenant, to eventually when you exit the property, company's super motivated to make sure that we're doing things the right way, not cutting corners along the way. And I think just what is the correct flavor of place for you to find your property? It just depends on what your goals are. And there's certainly other wonderful platforms out there. I think a pretty unique benefit here is since we do follow you on that journey end to end, we're differently motivated than someone perhaps who might just be looking to get the best price for an individual property and might never have to see you again. We and our teams do have to see you again over time. So keeps us honest.
Like, just to add to your comment too, it's like, not only do we have to see you again, that's how our business is positioned too. Like how we as a business make money in the long run is that we help customers buy their first ever home with Doorvest. And then from there, journey with them, stay close to them, earn their trust and earn the right for them to come back to us and purchase multiple homes. And that goes towards our mission of helping folks advance financial security, because at the end of the day, buying your first home is a huge, huge milestone. Many folks aren't able to even get there. But to build real generational wealth, it's really about a portfolio and being able to buy several homes.
All right, wanted to move on to evaluating and analyzing properties. And we actually have a question from the audience. They're looking to buy their first investment home ever. This would be their first home purchase ever. And because of that, are looking for some advice on what they should be looking at. Yeah, I think we're all kind of spread out in the way that we invest and what we look out for. Maybe Andrew, I think you alluded to some of the mistakes you've made, and what would you do differently if you were to go back in time and buy your first ever investment property?
Can we ask you the same question after, since But yeah, happy to go first.
Yes,
on
I will
this.
go as
I'd love to hear.
well. Yeah,
I'd love to.
great question.
hear yours. Yeah, great question. My first home, 2014, Sacramento, California. So those of you that know, we're based in San Francisco. I live in San Francisco. Basically spent my career up and down sort of the area. And so Sacramento is about a 2-hour drive outside of where I was living at the time. And so kind of at the time, there was not an easy way for me to buy remotely. And so I wanted something that's within a stone's throw. And so at the time, and this might be controversial, but I was optimizing for the most pro forma cash flow. And so usually, if you look at real estate, broadly speaking, as home values scale up, rents, so home values scale exponentially, rents scale linearly. And so when you buy a really cheap home, you in theory get more cash flow. And so I was etching out probably the difference between, I don't know, $150 in cash flow versus $200 in cash flow. And so I bought the absolute cheapest home at the time. It was a 3-bedroom, 1-bath in Sacramento, California. I've shared this story with, I think, the both of you before, but it was a total mess. I made so many mistakes along the way. And just to tell one story that sort of summarizes all of it was there was one time I had a resident, they moved out. I was going to look at the house to see what it looked like after, and resident moved out. I came to the house and unlocked the door, etc. And then I look in from the house, from the entry door. You could look straight to the right, and that's kind of where the kitchen was. The stove was there, and there was a person there cooking. Looked back at me, and it was, and she screamed at me, and she was like, "What are you doing in my house?" And I'm like, in my head, I'm like, "Wait, this is my house. What are you doing in my house?" But needless to say, she was a squatter that broke in. And so on different instances and in a similar neighborhood, had a different home where I brought it to a property manager because, again, I wanted passive experience. Like my goal was never to be a full-time real estate person. It was to build wealth, long-term wealth with real estate without sort of spending the days and time and hour in it. Brought it to a property manager. They said, asked for the address, gave them the address. They said, sorry, we don't manage homes like that. And so that's to say, I'd say my biggest mistakes have been around having too short-term of a view, which is the immediate return, versus finding really high quality homes in great neighborhoods that, one, are more reliable, both the home itself and the residents that live in these homes, but secondly, have stronger upside potential. And so needless to say, I had 4 homes in Sacramento that were like basically like the 4th cheapest home, the 3rd cheapest home, and all the way on through. And I ended up selling all of those. Fortunately, I did make a good profit, and that's kind of how my journey started. But I really wish I bought a couple tiers higher than that, because then I would have still owned them today, and that would have been the hope for me. So, anyways, long story short, high quality homes is kind of how I approach buying real estate today.
Yeah, and for myself, I'm going to try, I feel like I can go on, and I'm going to try to organize my thoughts a little bit. I've started, you can be almost, you will have some sort of paralysis by analysis, just looking at every single thing out there, fearful of every single thing that can go wrong. After, I would say, like a month of reviewing properties and analyzing it and working with my partner, we identified 3 key things that were important to us. And that really helped us with our decision making. And one of the key things that we were looking at was actually the school ratings, the public school system in the area. And as we were looking at more homes in that way, we realized that, okay, we might have to sacrifice cash flow, maybe for 1 or 2 years before we'll achieve the cash flow that we wanted. And when we sat down and talked, $100, $200 of maybe out of pocket expenses is fine for us. We can kind of go through that. And so after agreeing with my partner on, hey, this is what we want in a property, we think this property will appreciate in the next 3, 5, 10 years. And that's when we will start thinking about an exit strategy a little bit more closely. So because of that, we found a property in a good neighborhood with strong school ratings, and that was our key parameter. So yeah, I think my advice would be to think about your risk tolerance, think about what you want your first experience to look like, and don't be too strayed by a lot of these rules and pointers that you have to hit, because I think that can easily get you in over your head and you're kind of now just overwhelmed by the details. Despite losing some money in like that first year, it was okay because we have a resident in place that had stayed for a few years now and has not left. So we're proud of that as investors. So yeah, what about you, Mike? Do you want to hit on it, or should we go to the next question?
I'll give a minute or two here. I like to ramble, so I'll try to keep my thoughts organized as well. Way I always think about this personally is less about what the risk profile will be, more about if I can just tell myself what risk profile I'm looking for, and if I can underwrite what my actual risk exposure looks like. And really key for me, because I always want my cake and eat it too, is just understanding where those trade-offs are and that you cannot actually get that, right? Like when you buy a car, yes, I want the coolest, largest, fastest, most fuel efficient, least maintenance car. It's just not going to exist, and I'll never buy a car if I do that. Similarly for a home, just understanding what you're looking for. So I'll share my example if it's helpful to the audience out there. I'm busy. I don't have a lot of time to think about things. I'm working, so I have some cash flow. I know that I want to hold this for the medium term, probably not until the loan runs for 30 years, but maybe 15, 20 years with different life events coming. I might want to harvest some of my gains there. So I understood what I was looking for. I understand the time horizon. So little things like, hey, will I be a little bit cash flow negative for the first couple of years? Didn't scare me. Even better, I could kind of catalog, well, it's going to be about this much negative, and let's build in a little bit of reserves. I can put that money aside up front and not think about it for a long period of time. So the trade that has materialized over the last decade or so for me there is super, super, super stable. I have great tenants. They stay for 3 years before the next one comes in generally. They take great care of it. I have to go a little bit negative, but I know how much that is by and large, with a little bit of reserve for if the fridge goes out or if the stove goes out over time. And it's been appreciating sort of at the value, at the rate that I'm hoping for. So even though I am cash flow negative on this investment, it's one that if I was just focusing on yield, I probably never would have done this. But looking at the longer horizon, understanding what my goals are, I'm super, super happy with how this investment's playing out.
Cool. All right. Well, you hear it. You know, we had Andrew, who started with very cash flow, a little bit riskier investments, and what he perceived of it. And then Mike and I, who lost some money in the first year, but we're different. So if you're really like looking for that cash flow property, and you know you want it, then that's your goal, right? But definitely consider other things. And that's what we talk a lot about on our blogs and in these webinars. You'll see different ways to evaluate properties and considerations, because it's not that simple in just looking at, let's say, like financials. There's a lot more to it. And hopefully you can zero in on the things that are important to you. Okay.
Two quick comments just to jump in real quickly too. One thing is like, actually, if we actually did the math, like you and Mike both lost a little bit of money in your, I don't know, your first, second, whatever years. I lost a lot of money because I had to sell that home because it was way too much volatility and a headache. Like I'm very confident my figure is bigger than yours too. So I think that's a different lens to look at it. And then I guess the second piece is as I think about strategy, I often think about like the smartest people in our industries. And if you think about the folks that are the large hedge funds, private equity shops, the folks that own thousands upon thousands of these single family rental homes, Invitation Homes, American Homes for Rent, Pretium, etc. Like I often think about what type of asset and home that they're purchasing for their funds, um, and try to understand that. And I'm very confident they're not focused on the cheapest homes in cities.
I'm going to skip right into Q&A right now because we have a lot of questions. Let's do somewhat of a fire round to get through these. So I'm going to start with, what are the tax implications for someone that is interested in Doorvest but is not living in the state of where the property is at?
Long story short, and Mike, you could jump in after too, but long story short, definitely consult a CPA. And we know a number of them. So if you're a Doorvest customer, you could ask us for an introduction. We're happy to refer you to someone that we know. But the real estate carries at a high level a lot of tax advantages. One thing that you do not get to participate in is, like, I live in California, really high income taxes. The majority of my homes are in Texas, which has zero income tax. Unfortunately, I'm paying income taxes in California because that's where I live, and that's where I file my taxes versus in Texas. But what I would say is, like, there are advantages to there being lower income taxes in Texas. For instance, residents have higher take-home pay and therefore can afford more rent, for instance. So very case by case, but high level.
And I hesitate to say too much because also of the many things, I'm also not a CPA. Maybe in the future we can get someone who is to comment more broadly. But just going back to an earlier statement, right? There are many different ways that real estate can either flow cash in the short or long term or appreciate, and they all get slightly different tax treatments. So that's where talking to your CPA might also help you just figure out, how much of each flavor you'd like, and if there's a way to structure your purchase to sort of maximize your advantage. And I hesitate to comment as well because everyone's situation is super, super different. So definitely don't want to give any advice that leads someone astray here.
Okay, next question is, do you charge any fee to manage the property on behalf of the client? And if yes, how much?
I can comment on that, and Andrew, if you want to tack on, since I feel like you've been doing all the heavy lifting, will help. We charge a property management fee. There's sort of asterisks for when we do and do not charge, but generally in the steady state, this is like 10% of rent that we charge. And that lets us do all the things like making sure that the tenant's happy, getting the new tenants in. As they have questions, there's a light bulb that needs to be changed at 2 or 3 in the morning. Someone's able to take care of that and make sure that you're not bothered.
Okay, the next question is, will Doorvest help finance or find financing for the investor or client?
I'll take that since I'm off mute. But short answer is we do not finance in-house, at least as of today. We do have a number of partners that we work with, one of which helps us power a service called Mortgage by Doorvest. And so there's a number of lenders that we know really well, and we've worked with. They've serviced our customers well, given good interest rates, hint. And so kind of our job is to quarterback and spend time with the customer, et cetera, so that you get your best possible mortgage. This is valuable to us because the lower your rate, the better your service, et cetera. That leads to a better investment. And to Mike's point, the better your first investment is, the more likely you are to buy your next ones with us over the next series of years. And that's kind of what we're here to do.
The next question is related to mortgage. It's a bit long, so I'm just going to read it. The question is, what are the advantages of Mortgage by Doorvest compared to any other regular bank mortgage like Rocket Mortgage? That's question number 1. An extension to that is, do Doorvest Mortgage take into account the income that the house would generate once a tenant is placed?
I'll take this one. I'll work backwards through it, if you
Okay.
don't mind. So I think the second half was I think basically what you're asking is, are there loans in which you can take into account the income that the property is generating? So a broader answer, and this is where, if it's helpful, you should definitely get a hold of one of our client partners to talk this through. There are 1,000,001 flavors of loans out there that you can get, maybe 1,000,001 you shouldn't get. And when we're doing our job well, and our loan partners doing our job well, and when you understand what your goals are well, like it sounds like you do in this case, you want the property's income to sort of underwrite the loan, we can find the product for that. The specific loan product you're looking for there, of which there are still many flavors, is a DSCR loan. And these are loans where the income from the property is sort of the major thing that they're looking at. Of course, trade-offs, and that's where it's good to know what your investing goals are. I think the first part of the question was, are there any advantages for our mortgage by Doorvest product? Is that right, Kris?
Correct.
Yeah, so I think the key there is, well, one, they do a lot of work with our customers, so they understand our process. A lot of the trip ups that you might run into when you work with someone else, they're able to work through. Now, that being said, you can and you should take a look at all the various mortgage providers that are out there, just sort of commenting on things that have made our lives and our customers' lives easier in these scenarios. And with that particular offering, I just know on the in-house side, since we do a good amount of volume, our folks are familiar, they're familiar. Some of the trip ups, some of the things that cost us a day or two along the way as we move towards closing, we're able to kind of bowl those through, dance around, or we've dealt with before and already pre-fixed, so it just makes it a little bit smoother. But many wonderful lenders out there. Definitely bring your own lender if you've got one that you love and you got a good relationship, and you're getting the rate you want. Our team is great at making it all work out for you.
Cool. Thank you. All right. Another tax question. It's on do we provide any tax support? And yeah, basically they're Canadian and they're looking to buy properties in the US, but sounds like they're concerned about the tax portion.
This one I will definitely refer out to a CPA. I'll give an extra piece. I'm also Canadian. Hello, fellow Canadian. But also there are some extra challenges if you're an expat or out of country trying to get a mortgage to buy in the US. That being said, we have partners that deal with this specifically, probably not germane to most people on the call, but if you want to reach out, we can definitely put you in touch with those experts. They can help you sort of understand what you're able to do and what the implications might be, but definitely a specialized part of this that I'd love to refer you to one of our partners who's an expert on this one.
Yeah, definitely reach out. Any of these questions related to tax and more specific questions related to mortgage, you can email us at clientpartners@doorvest.com. We can refer you to some of our partners. Otherwise, you could also, reference anybody in your network to get more of these specific questions answered. Next question is, how does rising interest rates and higher payments impact the type of homes or deals an investor should consider?
Please say high level, yes. Interest rates are certainly higher than they were. And by the way, hi, Derek. Interest rates are certainly higher than they were a couple of years ago, even, and probably for the long stretch before that as well. Again, the background is lots of inflation in the US. The Fed uses interest rates as a way to curb inflation. Seems to be working quite well. And so I'd probably say for us specifically, this means that there's less deals and homes that pencil because the vast majority of our customers are buying with a mortgage. And so there's plenty of caveats in this and a lot of the discussion today. But one of the caveats is if you're buying with no mortgage or little mortgage, this does not have an impact on the return profile of the home. And if you're buying with a mortgage, again, the majority of our customers do. The rent to price ratio just has to be that much higher in order to fit your numbers. Like, we're not advocating for someone to buy a home with an expected cash flow of negative 500 a month. That just doesn't seem like the right move. And so for you to get to break even, slightly negative, slightly positive, that spread between the two has to be that much harder. And so the question is, how is this relevant to Doorvest and kind of our day-to-day work? Our teams actually have to look at a lot more homes, underwrite a lot more homes in order to come up with one that really works for Doorvest customers.
Yeah, your last point was going to be my first point. When in scenarios like this is where I'm super grateful that we've got an amazing acquisitions and underwriting team, because our standards stay the same, but the quality of like the way that assets are performing has changed. So for you, hopefully not too much change. For our teams, it means they'll have to look at many more properties to find those that have a return profile that we think are best for your customers. That's so I think what the biggest practical impact is sort of right now. But I think also just to, I mean, I feel like I echo the same thing, so I'm sorry I'm a broken record, but if you know sort of what your investment goals and duration are, you know, rough seas make good sailors. Now is a good time to think about what the next couple of years might bring, what kind of strategy you might bring. You might take different kinds of loans with different characteristics if you've planned this out. Like a good example would be if you're looking to own it indefinitely, controlling mortgages, phenomenal. If you're convinced you're going to sell it in 5 years, maybe there's a different mortgage product that can get you a rate you like and give you a bit of an edge over other investors or give you a bit of a better return profile. You can't make either decision without knowing what you're trying to do. But once you do know, a lot of options open up to you.
Cool. We talked a little bit about the DSCR loan. Others are wondering, what were the other creative financing options that we were going to allude to? I think we have had a handful of people, you know, using their stocks, their 401ks to invest in real estate, all which are very unique alternative ways to finance a real estate property that not many people know about. So let's spend a little bit of time exploring that question. And I know we're closing up on time, so we'll take another question after this.
This is Andrew and my favorite thing to talk about around the office. So I'll try to keep super short. Maybe I'll pick the ones that I know I'm thinking about hardest, leave you the ones, Andrew, that you're thinking about the hardest. I think some interesting things people have not thought about super hard are the notion of DSCR loans, ones where you use the income from the property essentially to qualify for the loan. You might pay a little bit of a higher interest rate, but the approval burden is a little bit lower. You have to do a little bit of math to make sure your lender, us, will help figure out which properties might make sense there. But the one that I'm really thinking about a lot, maybe I'm showing my age, Andrew, is I'm thinking about investing from your IRA. This is a place where for, I won't say the number of years, for many years, I've just been plowing some retirement savings in, buying the S&P over time. And sometimes I look at my bank account and think, gosh, I don't have enough liquidity to add to a real estate portfolio to get exposure. Well, I do. It's in my IRA, a place where I normally don't think about it as liquid. But it is. You can buy within there. And for some of my investing goals, I'm not looking to access that money for some time anyways. It's a nice, safe, efficient place for me to find liquidity and get a loan inside of that IRA to purchase a property. I'll pause there. Andrew, what do you love?
Thanks. I think a lot of this, again, goes back to what is your investment objectives. And so that includes horizon, that includes how much assets you have, that includes how much you're looking to deploy today, next year, et cetera. And so having a more cohesive sort of look helps guide what sort of tools, and a mortgage is really just a tool for you to invest in real estate. And so sometimes people ask me, what's the best real estate investment to get? I'm like, well, I can't answer that question without knowing exactly what you're looking for and what's your profile. And so anyways, let's just say mortgage as well. I do think conventional loans are great in the sense that they are really cheap. They're subsidized by the US government. Like the government, by way of Fannie Mae and Freddie Mac, literally subsidizes the 30-year fixed mortgage. And that's why we have really low mortgage rates, broadly speaking. And even with our high mortgage rates right now, we're still lower than the rest of the world. And like, this is where real estate is a foundational part of the US economy as well. So I do have a soft spot for 30-year fixed mortgages. That being said, I'm really interested in sort of stock-based loans as of recently. Like, I think you definitely, based on what we talked about, you own more public equities than I do. But a lot of folks that are tuning in here today, I bet, own some stocks, if not a lot. And a lot of folks probably believe or have a belief that the real estate market or the stock market is somewhere near bottom and do not want to sell at the bottom. But how do you use some of the cash there without selling? And so, anyways, that's kind of been one of the rabbit holes that I've been going down recently.
Amazing. All right. Wow. We had a lot of questions today, and I'm so sorry. We're going to have to cut it off right here, but we'll get to it offline through a follow-up. Thank you so much for everybody who participated in the Q&A section. Just wanted to really close it off here. I think that was a great way to end it with the creative financing. There's so much to explore, as you all can see throughout this discussion today. So if you have any other questions, definitely reach out to our team. And we want to close out and just thank you all for staying on. I haven't seen the attendee list go down at all. So you guys stayed here and stuck it through us through the entire hour. So I'm very, very appreciative of that. I'll let Andrew and Mike say any closing words if they're open to it, but otherwise, thank you again for your time today.
Just a quick thank you to everyone. Looking forward to doing more of these. If you have questions, please reach out. We love to talk about this, help find solutions, and you shouldn't have to be the expert. Use our experts. They're phenomenal. Looking forward to hearing from you. Andrew?
Yeah, thanks everyone. This was a lot of fun, as you could probably tell, or hopefully you could tell. A lot of us here, yes, we're building a business, and that comes with obviously business building stuff, but a lot of us are here because we enjoy this stuff. We really enjoy the topics, etc. And so that's to say we're not scary real estate people. We're just working people that are working to make real estate accessible. So please reach out, please chat with us, and let us know if this was interesting. Please do let us know, and maybe we could do more of it. And if you thought it was a bad conversation, please do let us know as well, and we're happy to do other stuff. So thank you. This is a lot of fun.
Yep, and stay tuned for a few more webinars in the coming weeks. And exactly what Andrew said, if you hated anything here, let us know so we can adjust it on the next webinar. But hoping to see you all again in the near future. Thank you so much for your time, and have a good rest of your day. Bye.